Welcome to the daily update. We'll go over the action in the market for Monday, October 23rd, and then we'll see how things look for Tuesday, October 24th. It looked like we were going to get a bit of a rebound. We got above the 200-day simple moving average. It looked like we were going higher, and then everything shifted and started to go lower again. We ended up having a down day. It's switching everything back more negative, and we now have a confirmed downtrend. But our list of extreme negative indicators is starting to get a little bit longer, and I'll go through all the charts and talk about what's happening. A lot of the hedging that took place ahead of the weekend seemed to come off on Monday, and so that's helping our equity put call ratio show some improvement there. But I don't know if that's really enough to really latch onto at this point. We're going to need to see some confirmation in some other areas. Let's go back and talk about what happened. Right at the open, we had a gap lower open. Things were weak in Europe. They ended up gapping lower in New York. Prices fell below S1 at 4206. So now we're dealing with that 4200 level, and we almost got down to S2, not quite, at 4188. As the day went on, we did rebound and we went above a lot of levels. We got back above S1. We got back above the unchanged level, which that's a built-in resistance level on a down day. So that was looking more positive. We got above the 200-day simple moving average, which right now is at 42.35. We got up to the daily pivot at 42.41. We didn't get up to R1 at 42.59, and then everything shifted. We started to fall back below the daily pivot, the 200-day simple moving average, the unchanged level, and we ended up closing slightly lower. So it's negative from the sense that we couldn't really capitalize on any rebound, and it's turning things a little bit more negative. We were down 0.17% on above average volume. And our technicals are switching more negative now, and we're seeing that confirmed. It's about inflation, interest rates, and the whole geopolitical situation going on in Israel. Some comments that we can make. There was a post put out by a hedge fund manager named Bill Ackman, and a lot of the folks that follow people like this and like Warren Buffett and so forth, they just treat these folks like rock stars, like it's their own religion, and that when they say something, then the market immediately reacts to that. It's interesting to know these things, but probably not a real healthy way to make decisions, because he came out and put a post on X, which used to be Twitter, that he said, I've covered my shorts in bonds because there is too much risk in the world to remain short bonds at the current long-term rates. So bonds have been going down, so he was short, and interest rates were going up. And now he said, we think interest rates are going to continue in some weird direction, but he was comfortable enough to close out those positions. But that helped the market right after the open. But then it's like, what this guy say? It doesn't matter anymore. It didn't last very long, and stocks ended up going lower. There's also this continuation of a fear that Israel is going to escalate things with the war with Hamas, and they haven't really done all that much yet. There's a lot of stall tactics going on. The media has pretty much turned against Israel. They're going to have to make the decisions that they feel are best for them. It doesn't really matter where you come out on one side or the other. We just have to pay attention to these things to see how they affect the markets, like interest rates, oil, and the dollar, and all of those other things that can play into this, because that can feed over into the market itself. The mega caps, even though we had a down day, they held up better. It was more of a broad-based retreat that we saw. Oil did close down. That should have given some support to stocks, and maybe it did. Maybe stocks would have fallen a lot more, but it closed down at 85.5. The S&P is still below its 200-day simple moving average. It's one thing to go down and break through it and then come right back up. We haven't done that yet. This is the second day now that we're below the 200-day simple moving average. The micro caps are still showing a lot of weakness. They set another new 52-week low. Here's our short term of extreme negative or oversold conditions. Some of these are the same as what I had for Monday's video. There's some changes as well. We have the 20-period exponential moving average, the Stochk RSI. That's a new one, where the Williams percent R had already been on there. The CCI 14 and 20 were still there. Here's a new one, the rate of change going back 5 periods. Not really extreme, but getting down to that level where we want to watch this. And our stochastics, which are pretty touchy anyway, they're giving us an extreme negative reading. Intermediate term, we have a little bit longer list now. We still have the 50-period exponential moving average, which was already there. The Erin indicator finally kicked into gear and has a new calculation to show us. The PMO studies, just one of those charts that we look at, is starting to look extreme, and we're getting extreme negative with the S&P 500 bullish percent index. It's now dropped down below 30. That's quite negative. It had dropped down below 30 and then came back above. That's usually a pretty reliable buy signal. Now we're going back down and dropping below 30 again. On a long-term basis, we have our 150-period moving average, which is still extreme negative. We're still dealing with this same basic scenario that we have been now for a couple of months, where the economy is potentially stronger than expected, and that'll come out in the form of these economic reports that we get, so that at a bare minimum, the Fed is going to have to keep rates higher for longer. We've known that. The variable here is, will they have to end up raising rates at some point? We're also dealing with China's weak economy. They're putting stimulus into their economy over there. Hopefully that will bleed through and help the Chinese economy, because so many companies in the US do business with China. That could have an impact on the S&P. We're just watching things sometimes hour by hour, if not minute by minute, with what's going on in Israel. And it looks like I am officially canceling my trip there for the end of November, beginning of December. Oil, we're watching that. It's falling down a little bit, but still at pretty high levels. And now we've got some pretty big earnings reports that are going to be coming out this week. The dollar was up, which put a little bit of headwinds in the face of stocks, but interest rates went down. That didn't really help stocks. Or you could look at it another way, saying that if interest rates had gone back up, stocks would have done a lot worse. We still have the 30 to the 5 and the 10 to the 5 that are back to being normal, and I'll show you those charts. The 10 to the 2-year and the 10 to the 3-month, and I showed these charts over the weekend, they're still inverted, but they're showing some improvement. They haven't crossed back over to looking normal yet. Sentiment actually ticked up a little bit. We had been at 26. It came in at 27, but it's still negative and not extreme negative. That won't happen until we drop below 25. We do have an update with our trend. We now have a confirmed downtrend. The trend is negative. The ADX is above its moving average, strengthening, and it crossed above 20, both with the short term and the intermediate term chart. Our bias is negative and our momentum continues to be negative. We didn't get any economic reports in Monday's session. There'll be some other pretty big ones coming out later in the week. We settled at 4.84% for the 10-year yield. That's still above the 4.02% that is pressuring earnings on stocks. Here's the intraday chart where we did gap lower down below S1. We never quite made it down to S2. And then it looked like, okay, gap lower, fill the gap, come up to the unchanged level, which acted as resistance. And one positive sign was we were able to break through that. We came up to the 200-day simple moving average and actually danced a little bit above that for a while. And it looked like, okay, maybe we're going to break out above the daily pivot. Nope, that fizzled out pretty quick. We came back down to the daily pivot, back below the 200-day simple moving average, back below the unchanged level, and that ended up being down on the day. So that was rather disappointing if you're more positive on the market. We're also seeing growth and value continue to decline. They were both ended up being down, but growth did outperform value slightly. So this is a little bit encouraging, where on a down day, where we did see our S&P 500 growth to value ratio actually advance. But when we look at the end of day chart, it did tick down, but recently we've been breaking out with growth versus value here. So far this continues to hold up. We're also keeping an eye on this. This is a bit of a concern. We have an equal weight discretionary ETF. That is now giving us a death cross. Discretionary has been one of the stronger areas in 2023 and was giving support to the market. The fact that in and of itself, it's starting to cross negative, that's not a good sign. We also have an equal weight ETF for staples. That's not really surprising. They've been under pressure for a lot of the year and have really been in a downtrend. But when you look at the ratio between the two, yeah, it's going down, but it's still in a longer term uptrend. We need to keep an eye on discretionary to see if it's going to bounce and start to go back up. That would be another positive sign that we're just not seeing right now. Here's the condition of our trend where the ADX is now crossed back above 20. So we have a confirmed trend. It's above its moving average. So it's a strengthening trend. The red line is on top and advancing, so it's a strengthening negative trend. And the green line continues to decline. The short term also crossed above 20. The red line's on top. We're above the moving average, and the green line is going down. So for right now, this looks like another confirmed short-term downtrend. We're also keeping an eye on the VIX, where possibly we topped out at some point, but now we're going down with stocks. So we're wondering, are we going to follow along the same basic path that the average has been from 1990 to 2022? The Ulcer Index coming back up and slightly crossing above its moving average, showing that fear is increasing. But we did tick down with the VIX with the line chart, but we're still above 20. We also came down and closed near the bottom for the VIX on the bar chart, but it also is above 20. We're showing that the volatility of the VIX is starting to come back down a little bit. A lot of this was the hedging ahead of the weekend because folks didn't want to be exposed in case something really wacko happened. And some of this could be explained by taking off some of those hedged positions. The VIX to VVIX ratio continues to go up. That's longer term negative. And I actually have the 1-day chart of the equity put call ratio. And I wanted to show this because we saw a real big decline, which doesn't necessarily mean that's positive for the market. This is what I was saying earlier, that this was probably a lot of put positions coming off and possibly even purchasing some calls, which really drove the equity put call ratio down on the daily chart. So we're looking a little more positive again. It's like every day we're switching back and forth with our 5-period simple moving average of the equity put call ratio. After Friday, it had started to go back up. Now, after Monday, it's starting to go back down. But be aware of that caveat with just taking off some hedging. We want to see if this can really continue to go down, or is it going to turn and start to go back up? Longer term, the equity put call ratio continues to advance. That's longer term negative. We saw a bit of a decrease with this fear gauge, and I haven't shown this in a little while, where we're actually ticking up a little bit with our other fear gauge that we look at. The mass index, we're wondering if a signal will be generated soon. We've crossed above the red dash line. We're still approaching the blue line. When we come back down below the blue line and then again below the red dash line, that's when a signal is generated. Whatever the market is doing at that time, this indicator expects there to be a reversal. So if we're going down, it looks like we'll be going up, and vice versa. Now, we did have another signal that was generated back in late August that kind of gave us mixed signals, because this signal was being generated as we were going down, and then we started to go back up, and the signal was then generated after that. So it was really contradicting itself. We'll see if we can get something clearer this time if we end up getting a signal. So looking at the advanced decline line based on price, we're showing weakness, and we're below the moving average, and we're showing even more weakness based on volume. We saw a real expansion of new lows and hardly any new highs, so now we're rolling over with our 5-period and our 10-period moving averages. We're well below zero with the blue and the red line. With our advanced decline ratio, that is negative. We're also looking more negative with the accumulation distribution. We're below now a declining moving average. The chicken money flow is starting to turn more negative. It was showing a lot of improvement. Now we're seeing that improvement going away and turning negative. We're still below the 200-day simple moving average. That's the red line here. And we might find some support at this pivot level, but there's a lot of other supports, not only in the S&P, but in other indexes that we still are waiting to see if those areas will hold. On the bottom, we did have above average volume. And we're seeing that above average volume has been more the norm lately. We're still extreme negative with the 20-period exponential moving average and 50-period moving average. 200 moving average continues to decline. We're extreme negative with the Stochk RSI and the Williams percent R, the CCI 14 and the CCI 20. Now, any of these indicators can continue to fall from where they're at. We just want to make note of this, knowing that they're getting rather extreme. We also have the force index, which had been extreme. It's still negative, but actually improved a little bit in Monday's session. Stochastic, short term, we're still extreme negative and trying to turn back up. We're getting extreme negative in the intermediate term, and we're negative in the long short term. The rate of change, this is one we don't show all that often, where we're starting to get extreme negative, meaning that we've gone down pretty far, pretty fast. It could go lower than this, or we might hit this level and then see some kind of a rebound. Here's the Arun indicator with its new calculation. The red line, which are sellers, that's on top. It's pegged all the way to the top, and the buyers are flatlining at the bottom. And finally, it picked this up. And so our oscillator, which had already been negative, is now starting to get extreme negative again. We don't see readings this extreme all that often. Looking at the cumulative NYSE advanced decline line, we're showing continued weakness. We broke through this other support level with the regular NYSE advanced decline line. Now we're coming down to this other area, seeing if that may provide support. We are negative with the Swenlin trading oscillator based on price and volume. The go, no-go system remains at a smoke on the water, deep purple. The TTM squeeze is now looking more negative. We had the lighter shade of blue, and now it's starting to roll over with the darker shade of blue. It's still positive, but it is declining. The balance of power is still a little bit above the midpoint. That's slightly positive. The highest high and lowest low values were coming down, and we closed off of the low. So that's one thing that's kind of interesting. But we're well below the midpoint, and the midpoint is now starting to roll over and go down. We're still below the 200-day simple moving average. The vortex continues to be negative with the red line on top. We're flatlining a little bit under zero with the ease of movement indicator. And this is with the BPI, the bullish percent index. We had generated a buy signal, but now we're starting to come back down. And we'll see, is this event, this could keep going from where it's at and fall even lower before it finally turns back up and goes above 30 again. This summation index based on price and volume continue to be negative. When we look at the broader market, the broader market, the NYSE summation index based on price and volume continue to decline. The Elder Impulse system for the S&P continues to be negative with red bars. The RSI based on 14 and 9 periods, we're almost getting extreme with the 9 period. We're still declining with the 14 period. On balance volume is showing weakness. We're below a declining moving average. We did see a real breakdown with the 200-day moving average study of the S&P 500. We also are seeing weakness with the 50 period, but we're actually starting to break below other levels now with the 200. That's longer term negative, where we're also negative in the more intermediate term. We'll see if this continues to go down. We're keeping an eye on the short-term fib levels. We're well below the 100% retracement level. Now we're seeing if we really start to break to the downside, are we going to come down to this other level that's at about 41.21? We're just a little less than 100 points away from that right now. And then longer term, we're below the 61.8% retracement level. Now, are we going to fall and come down to this 50% retracement level, which is at about 41.56? Longer term, I also extended this line out, and I draw these lines myself, so these levels may not be exact, but we're coming down to this double fib line right here, where there are two Fibonacci levels right on top of each other. We closed slightly above that, but we broke below that on an intraday basis. And then we're also getting a little bit close to this quadrant level here. If we continue to fall, I'll extend this line over. That's at about the 170 level. We'll see if that can provide support. The copy curve is still generating a buy signal, but it's crossing over and could go away very quickly. Where the Pring bottom fisher is just happily still giving us a buy signal, even though the market's going in the opposite direction. The PMO is now showing that our momentum is negative, both for the indicator itself. We're just ready to cross over negative based on price and volume. We're getting a little bit extreme with the PMOs that are rising. We're down with the buy signals, and we're also negative with the PMOs above zero. The NYSE bullish percent index is below 50 and declining and not extreme yet. That's negative. And we're seeing more weakness in the NASDAQ 100 bullish percent index as it's below 50 and declining and breaking below these previous lows. The slope oscillator, which is our touchiest and shortest term oscillator, is now getting ready to cross over negative. The MACD has already crossed over negative. So all of our indicators in the short term, intermediate term, they're negative now. We're still in the process of rolling over with the TRIX and the KST, which are our longer term oscillators. And we're still below the 200-day simple moving average with our moving average tree. We're still not extreme, though, when we look at our standard deviations chart. We're in the -2 standard deviation. It's when we get into the -3 area, that's when we've gone down pretty far, pretty fast. So this is showing just more of a sustained decline on this chart. The Chaikin oscillators below 0 and declining, that's negative. The money flow below 50 and declining, negative. Ultimate oscillator tried to tick up a little bit, but it's still negative because it's below 50. We're negative with the parabolic SAR with the dots on top. And here I'm drawing all kinds of lines, and I hate to do that because I'm a real advocate of the fewer the lines, the better. As I typically say, the more lines you draw on here, you can get a chart to say whatever you want it to. But I'm trying to stick to some rules here where we are coming down to a parallel line. If you go from a trend line from this high down to this high, this green line is a parallel. Well, we closed right down on that after Friday. Well, then I stuck back more to the rules of trend line should go from low to low, and that's the blue line here, and we're still above that. And if we do continue to fall, we'll be seeing, is that going to provide any kind of support for the market? Looking at our longer term moving average study, we're still extreme negative with the 150. We're declining with the 200, but we're not extreme yet. And the special case still hasn't figured out what it wants to do. This is a very long-term oscillator. So the fact that it's sitting right on top of the red moving average is not necessarily surprising. It would just be nice if this thing would end up making up its mind. Looking at traditional Dow theory, we broke down a little bit below this previous low. We have another low so far for the Dow. We're showing more weakness with the transports, and the utilities are back to looking weaker again. And the Zohorchak method, which had been giving us a buy signal for most of 2023, this was generated about a week ago, and it's still positive, but it's coming off of that really strong buy signal that it had been giving. The Staples to S&P 500 ratio, after really declining, they're continuing to go back up now. That could be negative for the S&P. Our 10-day average of the S&P 500 highs minus the lows, after giving us an extreme negative reading, are continuing to bounce up. Now, this is based on 10 periods, so it takes longer for this indicator to move, but the fact that we're still below 50 makes it more negative. And our 19-day exponential moving average of the advanced decline ratio, after coming back above 0 based on price and volume, now we're starting to drop back down with each of those. If we see more weakness, we might get another extreme negative reading. We're setting another new 52-week low with the micro caps. Our Heiken Ashi chart is negative with black candles. Our Kegi is negative with red lines. Our Renko is negative with a red box. And the 3-line break is negative with a red weird line. Then seeing the equal weight index, it really shot down more than the S&P 500, but they're both in pretty significant declines currently. So you can take this two ways. We're seeing more of a broad participation to the downside, which is holding up this ratio between the S&P and the equal weight S&P. You could take this as negative, saying, well, look, the mega caps are hanging in there for right now. Once an earnings report comes out or some kind of news comes out that the market really likes, we're just going to jet higher, okay? Those are some possible scenarios that could play out. The Dow is coming back down to this S1 level. It has not broke through this previous low yet, but it's negative. And we're also seeing negative with the diamonds for the Elder's Impulse system. We closed above this previous low right here, but on an intraday basis, we did break below that. So this is making this chart look a little more scary. But as long as we can still close above these previous lows, that's still something positive to hang on to for the NASDAQ 100. But we're still negative on a trending basis for the QQQs. We're also negative for the NASDAQ 100 with the PPO. We're coming down to the 61.8% retracement level here on the NASDAQ 100. And we haven't quite hit this even on an intraday basis yet. Are we going to come down and bounce up off of that, or are we going to break down below it? The NASDAQ also breaking below what had been previous lows, but they're closing right about at these previous lows. So again, this looks a little scarier than it really might be, but we need to see some bounce up out of this to get rid of this negative looking chart. And then we're well below the 50% retracement level now for the NASDAQ. That's more negative. The small caps, a recent death cross, showing more weakness, down almost 1%. Here's the Russell 2000. We're starting to get extreme negative with the RSI. Death cross, momentum is negative, starting to break below shorter term support. And on a trend basis, we are negative for the small caps. The mid caps, recent death cross, showing more weakness, also down almost 1%. So with the Elders Impulse system, we continue to be negative. The FANG index is actually up, believe it or not, but it's still below its 50-day moving average. This could be a period of some positivity to hang on to, and it could be some front running ahead of earnings, because a lot of the stocks that make up the FANG index are going to be reporting earnings this week. That's another thing to be aware of. Buy the rumor, sell the news kind of a thing. On a longer term basis with our arithmetic scale, we're still below the trend line. We closed below that, going all the way back to 2009. Looking at growth versus value, the Qs actually outperformed the S&P just a little bit. This is an area of concern that I pointed out earlier with discretionary, where we're seeing discretionary really underperforming the S&P. Large cap growth did outperform large cap value. So our different growth to value ratios, we saw a bit of a turn up with the large caps, mid caps, and we're still pretty much flat with the small caps. This is longer term negative with our 50-period exponential moving average of the new highs minus the new lows. We did see a bit of a tick up. Well, now we've had 2 to 3 down days with our indicator. So this red line is now going back down. Here is the indicator with the black line. We're well below zero, but we could be getting to an extreme reading right here. But nonetheless, it's taking our red line, which is the 50-day moving average, and sending that further below zero. Here are the stocks above their moving average for the S&P. After getting extreme negative, it looked like we were showing some improvement. Now we're starting to come back down, and we're seeing continued weakness with the mid caps, looking at their 50-period exponential moving average, and the small caps also showing some weakness and not quite extreme negative yet. This is broader based with the Amex, NASDAQ, and NYSE. When we take a 5-period moving average of the highs minus the lows, we continue to go further below zero. That's broader based negative. The dollar was up slightly and continues to be in an uptrend. The financial sector is continuing to break further below its 200-day moving average. Another few days of this, and we may see a death cross. And since we are falling, we're coming back to this longer-term support level, which at one time had been resistance. This has held up many times in the past, not exactly, but if we start to come down here, we'll really be watching this level. We're also entering into more of our new 50-day cycle, where right now we're continuing to go down. We did see the 10-year yield start out by being really high up at the almost 5% level, and then spent the rest of the day coming down. And our 30 to 5-year yield curve is still above zero and showing some improvement. We're also seeing some improvement with the 10 to the 5-year yield curve. And we're still seeing a pretty strong correlation when we take the 10-year yield and subtract the German 10-year yield. That's giving us a positive answer. That means that U.S. rates are going up faster than German rates, and the dollar continues to be going up, even though it ticked down just a little bit on this chart. But the correlation between the two is still fairly strong, and that could end up being negative for the market. Here's the Tom Bowley research, where we're coming more now into the negative part of the month. It hasn't really played out exactly like historically it has. So you might still, latch a little bit onto the positive side, but we're coming more into the negative side before we end up seeing some more positive action near the end of the month. So what's our outlook for Tuesday? We will get a lot of earnings reports from some really big influential companies. On Tuesday, we're going to get Google and Microsoft. Yeah, that might have just a little bit of an impact. On Wednesday, we'll get Facebook from Meta Platforms. And then on Thursday, we're going to get Amazon. These are the big players that have really been driving the market. The UAW strike is still going on. There's still not a new Speaker of the House yet. That's kind of turning weird and weirder every day. We're still wondering if things are going to continue to escalate in Israel. It's looking likely, but it hasn't really happened with the magnitude yet that really, at least personally, that I've been thinking might develop. Our technicals are negative, and now we're below long-term support, which is the 200-day simple moving average. We'll only get the S&P Global U.S. Manufacturing. That's one report. And then the Services PMI, the preliminary reading. These are not real influential. So the market's going to do what it wants to do. And then keeping an eye on all the different geopolitical events that I haven't already mentioned. Here's the updated economic calendar. On Wednesday, we'll get new home sales. The big one is going to be Thursday with GDP, and then we're going to get PCE on Friday. That's our other big inflation report. The Stock Traders Almanac statistics for October 24th were neutral to positive with the Dow. We're actually looking more positive for the S&P, and we're neutral to positive with the NASDAQ. We are coming off of options expiration, and we continue to be in that week where we tend to be down more than up. We will be on the 17th trading day of the month. When you take all the years together, which is the solid green line, we do see a decline, where we actually see a bit of a tick up when you just look at pre-election years for the S&P. And then wondering, it's been kind of hard to try to figure this out. Are we coming into this weaker time now when we have a sitting president who is running for re-election? And then we're looking at the Carson research. This is an updated chart just to kind of match more where we're at right now. Are we going to see some more weakness after this? The NASDAQ, are we going to see some more weakness? And the S&P with the green line, also more weakness before we see a bit of a bounce. We tend to be up a little bit more than down for the month of October, going back to 1950 and looking at only pre-election years. Bitcoin's actually getting a little bit of a bounce here. We're seeing some positive seasonality if you just pay attention to the green line, where we're pretty much sideways when you take all the different years together. But we're bouncing up. At the time I took this chart, we were just a little, well, we're about 34.5. So we're actually getting a bit of a breakout here. We're seeing some improvement, but we're still working off of a recent death cross. If we stay above this for any length of time, we might go back to seeing a golden cross. So our scenarios, we are leaning more towards the down one for right now. We can't justify going with the up one. If you did initiate any sideways positions, you might want to guard those pretty heavily right now, because now we have a confirmed trend. Now, we get a bit of a bounce in some of those sideways trends. They may be able to work off some of these things, but personally, it might be a little dangerous to continue to initiate those types of strategies because we are now in a confirmed downtrend. So the warning signs, our longer-term equity put call ratio continues to go up. The risk on posture, I didn't show you that chart because it's going down. Our oscillators show that momentum for the S&P and the NASDAQ 100 are down or negative. The BPI for the S&P is now crossed back below 30. The vortex is negative. The 50-period exponential moving average study of the new highs and new lows, that's negative. The parabolic SAR is negative. The Russell, the small caps and the mid caps, they're coming off of recent death crosses. Positive signs, we don't know where to put this, at least I don't, for this special K. It's just been sitting right on top of that moving average. And now the equity put call ratio is starting to go down, which could be positive. But as I've said for the third time now, that could be just some hedging over the weekend coming off. So we'll be watching the equity put call ratio again. The copy curve, even though the signal is weakening, it's still a buy signal. Pring bottom fisher, it's like, party like there's no tomorrow. Small and mid cap growth is positive. The financial sector, it's still in a positive trend with a recent golden cross, but it's well below its 200-day simple moving average, and that could be changing in the next few days. So our conclusion, we're negative. We have a confirmed trend. That trend is negative, and we're below longer-term support. In the short term, we're negative, but we're getting some extreme negative readings. Intermediate term, we're negative, and we're below support. And in the long term, we're negative because we're below the 200-day simple moving average. So thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.